Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted today to be able to speak to capital markets expert Jamie Constable, Chief Economist and partner at N+1 Singer. So welcome, Jamie.
Hello, Paul. Good to see you after 35 years.
Yeah, I know we went to school together. You were 1 year older than me. Anyway, it's easy to be super bullish, like myself included, on the economy and equity backdrop, given they've got huge amounts of pent-up demand. We've had successful vaccination rollouts and also enormous quantities of fiscal and monetary stimulus are being ended. What's your sort of view on the economy and the investment landscape in general?
Well, I think the question is, I mean, you're totally right, everything you said there, Paul. It's how fast the bounce back's going to be. I mean, we've had, is it a W, is it a V, is it whatever letter you want to think of? It's certainly going to be a V. I mean, certainly in the US, the question in the US, is it going to be red hot or white hot, I think is the economy there. They want to run it hot. You've had 1.9 trillion, you're going to get another 2.3 trillion, and then God knows what after that. Looking at the UK, obviously much more specific to us. We got the reopening happening now, and we've had first stats coming out from last week. We've chatted to a couple of companies. A private restaurant group told me that the average spend per head last week was 30 to 40% higher than pre-pandemic. So wow. I think that tells you how fast the bounce back in the economy is going to be. And the big question then is, how long is that? How prolonged is that?
Yeah, and what's it going to mean though for sort of the investment landscape? Because I mean, equities have obviously rocketed to the moon over the last sort of 6 months. Have anticipated a lot of this very good news. Have we sort of brought forward some of the gains, into prices at the moment?
I think yes. You know, equities discount the future, as we all know. So they're looking forward to what they expect to happen. So yes, I mean, markets are at all-time highs. We all know that. What does tend to happen, though, is analysts tend to underestimate the operational gearing on the way down, but they also tend to underestimate the operational gearing on the way up. And one thing that the pandemic has caused is cost cutting has been huge within companies. So I think what you have to look at when you're looking at companies now and looking to invest in the market is, what is the potential for the bounce back for those companies? Where were they in 2019? Where are they now? What are you looking at in 2022, 2023? But I think the big thing you will see, I mean, there's a small company called Norcross in the building materials tiles. They've had 3 upgrades in 5 weeks. Yeah. I think that shows we're going to get a lot of upgrades coming through. And going back to the economic side of it, you're going to see GDP upgrades for the UK as well. So the momentum is going to be strong. It's going to be strong through the rest of this year. The market likes momentum at the moment. I mean, you can see it with equities. When you see momentum is about a lot that is driving prices, you're going to get that momentum. For the market as a whole, we are at all-time highs, so we have to be very cognizant that valuations are, reasonably high. But that's what the market's there for. It's discounting this very strong bounce back in economic growth.
I think you raise an excellent point, because when you look at it on pure economics, you see the S&P 500 trading at over 20 times EPS, but the missing piece of the jigsaw is actually analysts have been slow to upgrade, and there's going to be a catch up. So actually, what is that 20 times? It's probably only 18 times. Yeah. And as you rightly point out when you mentioned with Norcross, if companies are increasing estimates and the analysts haven't caught up with it, then actually being that discounting mechanism, valuations are probably not as rich as people quite imagine. One thing that's really been scratching my mind, and I know investors, is sterling. I mean, it's gone now 140 to the pound, and likewise, we talked about sort of with inflation. What's that going to mean for bond yields? Because that gave a bit of a wobble earlier on, and now seems to have died down a bit. How do you see those two sort of variables?
Well, bond yields, US is obviously the big daddy of the bond market. So the treasuries went up, US 10-year yield went up to above 1.7%. It's come back down a bit recently. And I think the market's scratching its head a little bit on that. What I think it's back to that. The equity market is looking for the upgrades. The bond market is looking for how big the bounce back's going to be. But of course, the bounce back hasn't really started yet. We're right at that kind of tipping point of the economy is opening up in the US and UK, maybe not so much in Europe just yet, because obviously they're behind the curve on the vaccination front. But let's go east and look to China. the bounce back there, we're talking about unbelievable GDP growth numbers. What was it, 18%? I think it was. So it was 0.6% quarter on quarter, but 18% year on year. You're going to get numbers that you'll never see in our lifetime again in terms of the growth rates. But I think the thing is, the market now wants to see those growth rates coming through. So what does that mean to sterling? You're quite going back to your question. I think sterling should remain strong. Now, the big thing is flows move markets. I mean, one of the first economists talked to me. Flows move markets, and that's more the position, and that's more true for currencies than for anything else. So I think if people want to buy into the UK, they'll be buying sterling. That will drive sterling up. The sterling dynamics against Europe, I think, look very good. We've had a big bounce against the euro. I would expect to see that continue, which is great for anyone when we can go on holiday.
And that's sort of largely reflecting Brexit and presumably the better vaccination rollout.
Yeah. So you see that. Then you've got the inflation story, of course, which will drive the currencies on top. We've had some data today on inflation. It's moving. It's started to move up now. I mean, it's going to keep moving up to the back of this year. That's just the base effect of obviously very low numbers coming out. So you're going to see inflation move up. You're not going to know whether it's going to become secular in the economy or just transient until into 2022.
But what happens? Let's just put throw a number out here. Just doing governments to basically try and rebalance the income and wealth effect, and they decide actually to increase people's minimum wages across the patch, both in the US and the UK. And they've already said they're going to do that because it's unfair society. We've had asset price increases. If they do that, then frankly, this whole argument that it's transient inflation, it's just going to be blown out the water.
Yeah, it's retail price inflation, or CPI as we measure it now. That's not really the driver of secular inflation. If inflation is going to become secular rather than transient, it has to get into wages.
Yes.
Now, that's the key point, and you've hit the nail on the head, Paul. I think in the US, you've got a Democrat government now, president. They talk about a $15 minimum wage. We have minimum wage goes up every year here, and then so that continues to rise. It's not rising quite as fast as it has done, to be fair, in the UK now. But the other point in the US, of course, the share of company income that is taken by employees is at the lowest level ever. And I think everything we're seeing in terms of tax rises, government, it's what we've seen with the pandemic. It's focused government's minds. They spent billions, trillions even. They now need to replenish their coffers. So corporate tax rates are going up. I think we will see that rebalancing towards the employee taking more potentially, and that could drive wage growth. But we won't know that, I mean, in the short term. The numbers will, actually, you'll see wage inflation falling in the short term as the lower paid employees, 20% of the UK economy, of the UK workforce on furlough at the moment, come back in.
Yeah.
So the short term impact will be a small fall, but then what will happen going forward is a key question. And to be perfectly honest, we don't know the answer to that yet.
Okay, well, let's just run a quick scenario then, because it's a major risk for investors, both professional and retail. The economists, certain economists, are forecasting US CPI to hit 3% early next year, okay? Let's say it's not that transient. It doesn't drop back down to 2%. If you have an underlying base of 3%, then where is the 10-year treasury going to be? Because if it stays at 1.5, you've got a real return for bond investors of minus 1.5%. I just cannot see that sustainable.
No, it's over 2%.
It's got to go up, hasn't it?
It's over 2%. It's definitely over 2%. I mean, it needs to return. It's going to. I can't see how it doesn't return to 2% if we get the growth that we're talking about in the US. And in that environment, you don't want to be in bonds. You want to be in equities.
Yes.
And it's clear. So and as I said a minute ago, flows move markets.
Yeah.
If the flows are coming into equities because they're coming out of bonds, you think about when bonds went up, when bond prices went up and up and up, and yields came down talk about secular moves for a couple of decades. That money starts coming out. That's huge flows that have got to go somewhere. And in an inflationary environment, not high inflation is obviously bad for everybody. But medium inflation, well, you certainly don't want to be in bonds, as I said, but you do want to be in equities. So
it's good for the government to rebalance their debt to GDP level, isn't it?
Of course, deflate the debt. That's you almost wonder whether that's what governments want. They want inflation so they can deflate their huge debts.
Really? No, I don't believe that. Anyway, you whet my appetite. Equities. So where in equities, what sectors, what particular stocks do you think are going to be the places to be then?
Well, I think in the UK, we're just looking at UK equities here. So let's look at the UK. You've got the reopening trade. The question on the reopening trade and UK domestics is how much is already discounted in the share prices.
Yeah.
As we said earlier, I think as they do on the downside, same will be on the upside. People will underestimate the operational gearing of those businesses. So I think we will get upgrades. So I think you have to look at domestics, whether it's pubs, whether it's leisure, whether it's retail. The other thing on that, you talked about currency, sterling going up against the dollar is very good for the retailers because, of course, they buy most of their clothing, etc.
So people like Fraser's and the old Sports Direct and those kind of guys will love it.
Yeah, there's
Primark.
Exactly. At the top, you've got AB Foods with Primark, you've got Next, and then as you come down, you've got a company that we're broker to called Studio. They will all benefit from sterling strengthening against the dollar because they will have more pricing power. And pricing power has been one of the key in a low inflation environment. Pricing power is everything.
Yes.
And a little aside on inflation there, just quickly. Every company we speak to, and we speak to a lot of companies, inflation is coming through. Yeah. Every customer of theirs, Volex, we're a broker to. They've spent the first 3 months of this year putting their prices up, and the customer is going yes because everybody's putting their prices up.
Yes. So you want to be in stocks that basically have pricing power,
exactly,
that can actually maintain. If it sees prices, input prices increases, it's got to be able to then increase its own selling prices.
Exactly. Yeah. So you need to be able to pass it on. If you can't pass it on, you're getting squeezed.
Yeah.
So there's domestics I definitely think you should look at. Infrastructure. The one thing that we're going to see from the greening of the global economy, which is obviously essential, that we all need to see on personal as well as a business front, is infrastructure. The way you're going to do it is investing in infrastructure, whichever form it is. So on that front in the UK, we've seen through the pandemic RMI spending. I expect that to continue. I mean, Travis Perkins last week, Toolstation, one of their businesses.
So this is gardens and people doing their roofs and all kinds of home maintenance, DIY.
40% like for like, and that's pre-pandemic hitting. So they will continue to do well. People have got huge savings, which we haven't just touched on. I mean, the number I hear in the UK keeps going up every time I hear it. 150 billion, 160 billion, 170 billion. Yeah. There's a number in the FT about the global amount of enforced saving that people have had to do. Yeah. So that's going to come into the economy, and that's another reason that we're going to get some huge numbers coming through, and upgrades, I think. And upgrades, equities don't tend to go down if they get upgraded, let's be honest. So that's where to look. So infrastructure.
And presumably staycations this year are going to be absolutely massive in experiences, not only obviously at restaurants, but anything to do with theme parks or holiday destinations, those kind of places are just going to be lapping it up.
Yeah, pubs, restaurants, anything to do on the leisure side is going to do well. I mean, are the government going to let us go on a holiday? We don't know at the moment, but you might think that, I think 2019, the UK consumer spent 62 billion on overseas holidays. Yeah. They didn't spend that last year. And it looks like we might not be going on many holidays this year. Where's that money going to go? It's going to go into the UK economy. Yeah. Flows move markets, going back to the point I made earlier. Just returning to infrastructure, you've got a huge infrastructure story on the US as well. So stocks that are exposed to US infrastructure are good to look at as well. 2.3 trillion to come in. They need all their roads. Anyone been to the US, the roads need rebuilding, the bridges need rebuilding. That's
the likes of Ashtead, isn't it? And people like that, I guess.
Ashtead, Hill and Smith.
But in the UK, I mean, if they're cheaper valuations, so you've got your likes of your VP and you've got Speedy, haven't you?
Exactly. You think about HS2, what's that going to do? It's going to take huge capacity out of the market. HS2, whatever you think about it, huge capacity is going to come out of the market. That capacity comes out. Well, we go back to prices again and inflation, don't we? They're going to have pricing power because of that capacity coming out. So those companies should do well in this reopening, infrastructure-led investment environment.
Yeah, and what about, I'll give you the last sort of puzzle to solve for me, is what about city centres? Will
Well,
people start living in city centres? They may not be working, going to offices, but will they come back to your build to rent guys and your students coming into city centres and all this sort of stuff? Are we going to get back to some semblance of normality for that, for restaurants in city centres and just normal services for city centres?
Well, we spoke to a couple of restaurant companies in the last few days, as you would expect, because we had the reopening last week. They are still, they're quite cautious on their city centre restaurants. The key for city centre restaurants, you're not going to make money if you've only got people coming in on a Friday night and a Saturday night. You need that through the week trade as well. So you need the office workers to come back. It's very interesting at the moment. I mean, I'm in the city here. This week, you get noticeable, a lot more people back. Each day, there's more people coming back. So that is the key for the city centre ones. You need the footfall of office, people coming back to the office, going back to work. I don't know about people watching this, but what's their feeling about going back to the office? What I found, and we found here, is that people come back, they reacquaint, they start chatting. They actually go, maybe it's a bit better being in the office. I definitely think we'll still have the split. It might be 3-2, 4-1 office and work from home, which is obviously very good for everyone's kind of personal point of view and personal health point of view as well, I think, looking forward. But that's the key for these restaurant companies. What I do think we'll see restaurant companies opening a lot more restaurants in suburbs. And maybe dark stores you'll have dark restaurants where they have the Deliveroo led or Just Eat led delivery from those. So they're cautious on their city centre restaurants at the moment because no one knows how many people are going to go back to the offices. But I don't know about you. Have you tried to book a restaurant at the moment?
Yeah, no, it's impossible. Absolutely. Well, I think everybody in the whole area where I live are desperate to go out from, and frankly, there's no free available seats in any of the places, the pubs or whatever like that. Just moving on. What sort of key risks should people look for, or should we say keep tabs on? I mean, are we talking about I don't know, an implosion in Bitcoin? Are we talking about higher sort of like a potential variant coming forward that is like hitting India already? Those kind of things that would obviously scupper this whole reopening side.
I think the pandemic, obviously the virus is a risk. We saw a bit of a correction in the market yesterday. That was on US Airlines numbers coming out not quite as good, but also the US saying they were looking at putting travel restrictions on for US, which would mean 80% of the world wouldn't be accessible for US residents. Now, that is a risk. I mean, because the market is, for certain parts of the market, that is obviously a risk because they're discounting now the fact that people are going to be able to travel again, or people are going to be able to go out to restaurants. If we get locked down again, well, the market will switch.
Yeah.
So back into all the names that did well during the pandemic again. So it's flows of funds again. I mean, yields will probably then fall again. So that it will be good again for the technology part of the market and the NASDAQ and everything like that. So the market will move.
Just on that risk though, Jamie, let's just run that one because I think that's the biggest risk. I think you've hit you've absolutely nailed it. If we do get another nasty variant which hits Europe, the UK, there might be different ones, but they hit the US, UK and Europe, big economies, will governments just come up to the, basically come to the rescue again and just carry on, spend? I mean, they're all in already, so why not carry on all in? So if we got this underlying put anyway for investors, at least for the next shot.
They've got no choice.
Yeah, I thought
they've gone as far as they've gone now. They've got no choice. They'll have to come back in. And if you look at the UK, the furlough scheme doesn't end until September, so that's already been stretched out. They've got no choice. They've got their money. They put their money to work. They can't just withdraw it now. So yeah, I think what would probably suffer the most in that environment are the holiday travel stocks. They're the ones that get hit the hardest in that environment because look at New Zealand, look at Australia. They've got very much the pandemic under control, but their borders aren't open. You can't travel. They've actually got it out. They have actually got you can now actually travel between New Zealand and Australia and backwards and forwards, but you can't travel to anywhere else.
Yeah.
And that's maybe when you're in the UK, we don't quite realize that. But these economies where the virus is under control, borders aren't open.
Yes.
You can't travel. So
let's just run that one. So we get a nasty variant. We go back into lockdown. Governments come to the rescue again, and then equity markets go down. This is the $64 million question? Is that the time to buy the dip?
Oh yeah, it will. I think the market's interesting nowadays because you don't tend to get death by 1,000 cuts, which is where you fall 2% a day. You get flash crashes nowadays because of the structure of the market. So I think, yes, people will look to buy the dip if that happens. The money's going to come back. I mean, if it's a variant, they'll come. What has been proven so to date is that we can produce a vaccine very quickly, particularly with the Pfizer and the Moderna versions of it, and they can tweak it within 6 weeks to produce another vaccine that will hit the variant. So it's deferred, isn't it? It's recovery deferred rather than recovery gone away forever. But yeah, the market would not like it. Let's be blunt. The market would not like it. If we start, as you saw yesterday in the market, if we start locking down again, the market is not going to like that. So we have to. That is very much, as you say, a big risk.
Okay, brilliant. Well, thanks very much for your time and insights, Jamie, and really look forward to touching base again in a month's time.
That'd be great. Good to see you, Paul.
Yeah,
Speak soon. Thank you.